Okay guys, in this video I'm going to be covering a common myth in property investing, and that myth is that LMI, lender's mortgage insurance, equals bad. We see a lot of things in the mortgage in property investing that people do not want to pay lender's mortgage insurance, and it's made out to be this really bad element. Now I've got to tell you guys that I actually love paying lender's mortgage insurance, and I'm going to share with you in this video why I love paying lender's mortgage insurance and why you should not let it affect you or believe that it's not a reason to go at higher loan to value ratios. Now this obviously all depends on your strategy and is different for different people, but let's actually get clear on what lender's mortgage insurance really is and how it can potentially help you or hold you back in your portfolio, whatever the case may be. Now, for those of you who don't know, what lender's mortgage insurance is, effectively in essence, is that it's insurance for the bank to cover the bank if you default on your mortgage. But the funny part of that is that you actually pay for the privilege of the bank's insurance, which is interesting, but that's just how it works in the Australian property market right now. So usually you only pay lender's mortgage insurance and when you go over an 80% loan to value ratio. That's usually only when you pay lender's mortgage insurance. And as you go higher and higher in LVR, whether it be 80 or 85% or 87%, 90 or 95%, it goes up in a sliding scale of how much lender's mortgage insurance that you are going to be paying on a particular property. Now, usually when you're sitting around somewhere between 90 to 95%, it's usually going to work out somewhere in the vicinity of 1.5 to 2% of the overall loan that you're applying with the bank. That's how it usually work out. Once again, a lot of lenders and mortgage brokers will make out that lender's mortgage insurance is a bad thing to do. But let's actually have a look and understand how it can really help you in your portfolio and allow you to leverage your portfolio, especially as you're starting out in the investment property game. So let's understand how that actually works. Now, so we're going to look at two scenarios. The first scenario is at an 80% loan to value ratio where we do not have to pay LMI, right? We don't have to pay lender's mortgage insurance. And then we're going to go at the other extreme and go at 95% loan to value ratio where you're paying your maximum amount of lender's mortgage insurance to get that higher loan to value ratio in the marketplace. So let's talk about it. So we're going to use some real figures and talk about is if we have $100,000 that we're committing to investing in our property portfolio. We want to understand, okay, well, what is the maximum amount of real estate that we can afford to buy at an 80% loan to value ratio and a 95% loan to value ratio? That's step one. So we covered this in an earlier video, but just very quickly for you guys. Under an 80% loan to value ratio, we're going to need to put down a 20% deposit plus 5% cost. So we're going to have to put down a 25% deposit per property under an 80% loan to value ratio. And so then we want to calculate, well, what is our maximum buying power? How much real estate can we afford to buy based on this scenario? And how we work that out is that we take $100,000, just like the previous video, we divide it by 25%, and we're going to come up with a figure of $400,000. And that is the maximum amount of property that we can afford to buy based on a 20% deposit, 5% cost, with $100,000 willing to invest. Now, if we go on the other side and we talk about a 95% loan to value ratio, so we're going to need a 5% deposit plus 5% costs, which is going to equal 10% deposit. Plus, we are also going to have to pay some lender's mortgage insurance in this phase. So I'm going to use kind of more of a 2% figure as an average when we're going at a 95% loan to value ratio to be a little bit more conservative. So we're also going to have to pay another 2%. And so we're going to need a 12% deposit for each and every property that we are going to buy at a 95% loan to value ratio using $100,000 initial deposit. So if we take $100,000 divided by 12%, I hope you guys have your calculators out, this is going to equal around about $833,000. Now, if it's $850,000, $860,000, don't get caught up in the detail, guys. I just want you to understand, okay, well, what does it really mean for us as a property investor? So that's what I want you to focus on. So what you can see here is with the same amount of capital, $100,000, it has allowed us to leverage and to literally double the amount of real estate under a 95% loan to value ratio. Now, some of you might be sitting there thinking, Todd, well, hang on, Todd, isn't that more risky? Well, you've got to ask the question, well, whose risk is it? You know, right now, who has more skin in the game under an 80% and 90% loan-to-value ratio? So, of 95%, so the bank has more skin in the game. You only have a 5% plus your cost, so 10% in the game at this point in time. The bank actually has more skin in the game right now, so it's actually riskier for the bank. Now, of course, you have to protect yourself. You've got to have your buffers set up. You've got to make sure your cash flow is right. You've got to be able to manage this first and foremost. So very, very importantly. But again, I'm trying to illustrate a point about the benefits of LMI if that's part of your strategy. So let's just imagine using some simple figures. Let's just imagine that each of these properties are in the same area, it's the same property, and it grew by 10%. Okay? So in a single year, it grew by 10%. So ask yourself the question, how much have you made in this scenario over here with this property at 80% loan-to-value ratio with one property? And the answer is, okay, $400,000 plus 10%, that's going to be $40,000 in profit. Okay, that's how much you've made. Now, because we've been able to leverage in a double amount of real estate, and these properties over here have also grown by 10%, we've actually been able to create $83,000 in profit in this scenario over here. Again, double the amount of profit. As long as you've done effective due diligence, you've bought the right properties, you know what you're doing, you've got your right strategy. So all of what I'm talking about is based on you doing effective due diligence and making effective property purchasing decisions based on an effective strategy that you've created first and foremost. So we'll be able to create an extra $43,000 in profit under the same scenario by being able to leverage a little bit higher. But of course, you've had to pay some lenders more insurance over here, 2%. So now what you want to ask, well, how much is that lenders more insurance? So what we're doing is we're asking, well, what is 2% of around $833,000? What's 2% of that? Get your calculators out. Make sure you do the numbers so you get used to doing these calculations. So the answer is it's going to be around $16,000. Don't get caught up for $16,100 or whatever it is, right? But it's around $16,000 of lender's mortgage insurance that we've had to pay. So now we've got to ask as an investor, is that a good return on investment? That's how an investor is always thinking, return on investment. Is it a good deal if I invest $16,000 in paying lender's mortgage insurance, which then allows me to invest in $833,000 and leverage a double the amount of real estate, potentially leverage against creating an extra $83,000 in profit? So the actual profit we potentially made here is 43 grand. So you've got to ask the question, okay, well, would you give someone $16,000 if they were going to say, well, I'm going to give you $43,000 back? That is really the question that we are asking. Is that a good investment to invest $16,000 if you have the potential of getting $43,000 back? And the answer is, of course, is absolutely. So guys, you've got to get over this lender's mortgage insurance. It is a cost of doing business, and your property investing is a business, and that's the way you have to treat it, right? So lender's mortgage insurance is a cost of doing business. Now, obviously, this is all, if you leverage at a higher loan-to-value ratio and you do a terrible deal, it's obviously not going to help you whatsoever, but no terrible deal is going to help you no matter what loan-to-value ratio you're going to be going in at, okay? So LMI is a cost of doing business. Now, then you've got to ask yourself, okay, well, because it's a cost of doing business, is that actually potentially a tax deduction? And the answer is yes, absolutely, potentially. But of course, make sure you go check with your accountant first and foremost. But it's potentially a tax deductible expense. And you can also potentially, depending on the lender, capitalize it on top of the loan, meaning that rather than a 95% loan-to-value ratio, it's a 97% loan-to-value ratio. Or maybe if you're going at a 90% loan-to-value ratio, and rather than a 90%, it's a 92% loan-to-value ratio. So you can potentially add it on top of your loan, which is what capitalized means. Then the interest proportion you have to pay on it, again, you claim it on tax. So guys, what I got to say is just get over it. It is a cost of doing business and can be a handy benefit of building your property portfolio. Because ask yourself the question, if you're always going to have to save 25% deposits per property, how long is it going to take you to save up that amount of money? How many property deals are you going to be able to leverage into in a shorter period of time if you continually had to put down a 25% deposit? So as we're starting our portfolio, it's great to be able to leverage higher, maybe at 90 or maybe at 95%, depending on your strategy. As long as you protect yourself and get great deals, it could be a great benefit of being able to build a portfolio faster. So I love paying LMI, guys, and this is the reason why, because it allows me to get my money out there working much harder for me than I'm putting down 25% deposits on every single deal. Thanks, guys. We'll see you in the next video.